Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seymour interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seymour.
Welcome, everybody, back to another episode of the Apartment Guys podcast. And we are rounding out the year 2021 as we record this episode. And it has been a huge year in the world of Greenlight Equity Group and what we've been able to get done. And it's been an amazing year on the Apartment Guys podcast. And I'm lucky enough to get to share this last episode of the year recording. This will probably air the first week of January, or first or second week of January, but we're recording here in the last week of December. So I'm sure everybody's kind of in like New Year's resolution mode and setting new goals mode and that sort of thing. So it's going to be awesome to get to talk to my friend Chris Freeman here, who we have on the show with me as our special guest today. And Chris is a multifaceted real estate entrepreneur and has been in the business for what is it, about 20 years now, Chris?
In the real estate business for 20 years.
Yep. And you're an investor. You have 20 million in assets under management, which is nothing to sneeze at. That's awesome. Over 440 units. And you really have grown your business, and you started off, we were talking beforehand, you started off kind of in the smaller multifamily space where really a lot of us start. I mean, my first deal was a 12 unit and then a 20 unit. And then after that, we were able to kind of bust into the 70 unit plus, 100 unit plus, and then 190 units and kind of go from there. But I'm real interested in talking to you, Chris, kind of first and foremost, hearing a little bit about your backstory and kind of how you put your trajectory together as you got into real estate investing.
Yeah, you bet. Well, Tate, thank you for having me on the show, and I'm excited that I get to be the last guest of the year. Yeah, so it's an honor.
It is, yeah.
Yeah, so I actually got started. I've always been in technology sales, and I got started in real estate back in right about 99, 2000. I was heavily invested in technology stocks in the stock market, and heavily invested in a 401k where the company I was working for, if you took their 401k match in stock, they would almost double the match. And so I was like, well, why would you not do that? Right. And then at that time, I started to kind of look around and say, I should be looking at real estate. So I did buy a duplex, moved into half, and that was my first exposure. But I mean, I didn't consider myself an investor at that point. Well, then if you know anything about the financial history, the dot-com bubble collapsed. Yep. And stock portfolios, were heavily weighted in technology stocks. Those cratered. And it was not like the Great Recession where the market came rip-roaring back, because those companies went out of business. Yeah. There was nothing to come back from. Yeah. And so at that time, I had my future partner, who was about 30 years older than me. He had already made it in real estate. And I was watching him rolling in some really nice income all throughout that specific recession. And what I learned at that point, and at the same time, all of his pretty well-to-do friends were starting to cut back on, their foreign travel, their dining out, because they were all living off their fixed funds or fixed income or their stock portfolios. And so when I saw him bringing in that income, that's when I said, all right, I'm going to double down, put all of my extra earnings and commissions into real estate and start to build up that cash flow. So bought a fiveplex. And, it's funny because I bought the fiveplex, and that just, to me, is like, wow, I just doubled my portfolio. I went from 2 units to now I bought a 5-unit building. And it's, there's that saying of that first domino, right? You get that first domino to tip. It gets enough momentum to tip the next domino that can be just a little bit bigger. And then that one can tip, and maybe the next one's even bigger. But, you got to get that first domino to go. And after that fiveplex, that we were off and running. We would generate cash flow, never take any money out of the account, just let it build up, throw a little bit more in there, and then go buy the next one. And so kind of compounding off the compounding of the cash flow. And we went and did that for 15 years without ever taking a penny out.
Wow.
And built it up to about 110 doors just in our backyard here.
So you never sold anything, you never refied anything, you just kept you just let the cash flow build the portfolio.
Yeah, well, we did sell one or two. Funny enough, I did sell that fiveplex. It was a long story, but lesson learned on that one. Sold that, and we did roll that into a 22 unit building.
There you go. I mean, that's that's how you do this. You scale up. So if you do sell, then you're just moving that equity into a larger asset and leveraging it more, right?
Absolutely.
Yeah, good for you. So through this whole thing, and so you built up to 110 door portfolio. And when was that? And you did that with your future partner?
Yeah. So most of that was with my one partner, and we accomplished that about 5 years ago.
Okay.
And it really, after we hit about 100 doors, I was really struggling with the scale because we were self-managing. We had a great division of labor, but we were both pretty busy, and it's hard to go find new deals and grow or add to the portfolio when you're operating the business. And so we then decided to move everything to property management. One building, we were struggling to find the right manager. So I think, we're actually in contract to sell that. So we did that, started that process a while back. And that then allowed me to step back from the business and look at how do I diversify outside of Oregon? And then if I'm going to diversify outside of Oregon, I can't do it by myself. So how do I find partners? Well, if I'm going to go find partners, I might as well go do a bigger deal. Mm-hmm. And that's really where I started to figure out how to go from 25 unit buildings to 100 plus unit buildings with partners.
Mm-hmm. Did you need to go outside of Oregon because of inventory, just lack of larger unit count properties in the West? These younger cities we found out here in the West, we're in Salt Lake City, as you know, they seem to just not have as many larger buildings.
Yeah, that's definitely the case. And that's why we were kind of running in the sweet spot with the 10, 15, 20 unit buildings. But in order to scale, there are some here, but the inventory is low. And so, it's definitely a little bit more competitive. And the other challenge was, as somebody that was intimately familiar with operating the units here in Portland, it's not a landlord friendly state, and even worse for a city. And so I just wanted to diversify some of that risk. I mean, the tenant dynamics has changed so much over 10 to 15 years. We've always had kind of the, Class C type buildings, and definitely affordable workforce housing, and tenants were always very appreciative. And that sort of mindset has shifted to where the risk is just so much higher, which is also another reason that I put it all under property management, because, you have to be just incredibly diligent with your record keeping, maintenance records, everything, because it's not a matter of, not a matter of if you get sued. It's just a matter of when and how many times.
Yeah. Right. Yeah. Well, I think, if I could editorialize for a second,
Please do.
One of the things we talk about a lot here is not self-managing. And that's just something I've learned from my mentors over the years is to, at pretty much at all costs, not self-manage, even if it's a small building. And so like our 20 unit out here in Utah, we put under a third party property manager, and holy cow, is it like the best thing we ever did. He has done an incredibly good job. I'll just give him a quick Scott Cruz with Concept Property Management here in Utah. I'll give him a shout out. And he handled our renovations and construction and all the bookkeeping, and has made our lives so easy that we basically read a weekly report. We meet with him once a week because we are doing renovations. Otherwise we wouldn't meet as frequently, but it's a beautiful relationship, and it has allowed us to do what you were talking about, which is to focus on profit generating activities, that like finding new deals and going out and finding new partners, raising capital, doing the things that it takes to get the deals done. and not get bogged down in the minutia of the management side of things. So I'm sure that was felt like a big upgrade in your life when you did that.
Oh, it was. And, I'm glad you figured that out early. I've always, I guess my upbringing, I came from more of, I guess maybe a scarcity mindset. So it's like, the idea of giving it to a property manager and giving up 5%. Oh man, that's my profit.
Yeah. Right.
But what I learned was, wow, they earn that back. And, they drive the rents higher, they execute faster. They, on the downside of the risk, they avoid risk that could wipe out some income in any given month. And so it pays for itself and then makes you money.
Yeah, absolutely. Ideally, the right one is making you money. Your NOI literally is higher as a result of them managing, even with their 3 to 8% in there, whatever you got to pay to get it done. And for listeners who aren't familiar with that range, that's typically you're paying 7-8% for a property that's small, that you can't have on-site management, staffing, and that sort of thing. Whereas a larger community, you're going to pay more like 4%, maybe 5%, and you may have a few people on payroll as well. So awesome. So you've done all of this, Chris, with the W-2 job, and you must love to do that too, obviously, or you wouldn't still be doing it, I wouldn't think. So tell us a little bit about that balance and how that works for you.
Yeah, the W-2 job, just the industry that I'm in it's high tech sales, and so I've always enjoyed it. It's different, it's challenging, always learning, and so as a lifetime learner, it fit my personality. Mm-hmm. And sales does offer a certain amount of flexibility. I mean, at the end of the day, it's about putting up numbers and delivering on a measurable quota. And if you can go do that and overperform and get it done in 6 hours in a day, well, you can go cut out for a couple hours and go work on your rentals. And I've always liked that flexibility. But I will say the thing that I've always been really passionate about is if somebody has a W-2 and they're working in real estate, you owe it to your W-2 employer to show up and put that as a priority first. And if you're not doing that, I just think it's sort of an ethical dilemma that then sort of infects your ability to be successful on the real estate side.
Sure.
So you've got to find that balance, and got to do the right thing around the W-2 employer. And I've done that now long enough to where I have a track record of performing. Nobody doubts that I'm committed.
Sure. Yeah. It's a good cost benefit analysis for them, for them to get, really how truly valuable you are to them. And like you said, you've proven yourself, which affords you the freedom to do what you need to do inside of, and want to do inside of real estate. So have you, I mean, it kind of begs the question, have you thought about going full-time into real estate? And if so, how has that thinking gone for you?
Yeah, I have, and that's definitely here in the future. But the reality is, as I shift more into professional or full-time real estate, it really would be shifting more from the active to the passive side. So, maybe taking more of my dollars and investing those in passive positions than being a sponsor or syndicating deals. Because if I'm going to, my nature is if I'm syndicating a deal, we're raising capital, I am all in all day, every week, because I have investors that I need to take care of. And until any of those close out, I'm committed to making sure we deliver on that. So I, eventually be finding that balance of continuing to invest, but in a more passive way and benefit from that passive income.
I think that is incredibly smart. We've talked about this a lot on this show about how that passive position in these deals is really like a pole position. It's really like as good as it gets as far as your security in the capital stack, so to speak, and you get paid first, and typically in a preferred situation, you get a preferred return of anywhere from 5 to 10%, usually somewhere right in the middle there. and then you're, of course, you're an equity partner as well in the deal, and you're typically a majority equity partner. Like the limited partners actually own more of the deal than the general partners do. And you're secured by your ownership in a cash flowing asset, which is a very good place to be, in addition to the tax benefits that you get to enjoy as a passive investor, and the bonus depreciation that we've talked about in the past and all of that. So I think that's incredibly smart thinking. In my limited years in this business, if you were to have said, like, what do you think, Tate, like, as far as direction as to where to head, I tell people all the time to think about the end game and the kind of the longer game as being a passive investor, even if it's in your own deals, right? Like that is just a really good end game and a good place to be when you can get there. So
yeah.
Good
well,
job.
and just the idea of the passive income, when I look at people in my industry, and I've met some people that were older than me that, I'll pick a number. Maybe they were 55, 60, still just grinding it out as a sales rep, and they probably have made a ton of money. Yeah. And they've got a 401k that they've probably maximized. But I've asked a couple of them in the past, like, why are you still working? And the reason why is because their lifestyle had creeped up. And in order for them, if they were to leave and retire, their 401k is not going to be able to maintain that level of income. And, it was great that they invested and saved in the market, but they didn't set up that passive income stream to replace their active income stream. And so that's something that's always been in the back of my mind that it's been really important to me.
Yeah, that's so smart. So along those lines, you were talking about these colleagues of yours and people that in the industry. You founded High Tech Freedom with the thought of helping those high tech sales professionals create passive income in real estate while they're in their W-2 working it. Talk a little bit about High Tech Freedom and what you do with that.
Yeah, as there's so many people that are in the real estate business, and lots of great podcasts, lots of great platforms, and what I was thinking about is if I wanted to continue to grow my real estate business and provide value, who are the people that I connect with the best? Mm-hmm. And I started thinking about it, looking at my own LinkedIn network. Is like, 80 to 90% of my LinkedIn network is all technology people. And 80% of those are all salespeople. So I was like, why don't I take the three things that I'm most passionate about and blend them together? So the whole High Tech Freedom is, in my mind, kind of a platform where I'm taking the tech sales that I love, and it's innovative and interesting and always changing. I can take the coaching aspect. I'm a sales leader. I provide guidance to people in the real estate business as well. And then I can bring in the real estate piece of it and help some of those people that, maybe they're 10 years behind me in their career, help them invest in real estate along with us, while continuing to go kick butt in their sales role and really crush it, with the commissions. And so bringing those three things together, for me, it's sort of my way of doing what I love and giving back in the process.
Mm-hmm. Yeah, that's so smart. So you kind of went with the flow as far as you took your sphere of influence, basically that you have the most reach inside of, and basically capitalized on that by reaching out to those people, providing value, like high level value to those people, by helping them invest in cash flowing real estate. Like that's pretty awesome.
Yeah, and so a lot of your listeners are probably somewhere in their real estate journey. And something that I learned really about a year ago was that, it's really in any sales now. There's so much noise out there with social media, with all the different platforms. If you are trying to scale up your real estate business, how do you get known? Mm-hmm. And, I'm never going to be a Grant Cardone. I mean, I shouldn't sell myself short, but he's already got a certain brand out there with the 10X. And so one of the challenges is, how do you get known? And we're all little fish swimming in this giant ocean. Well, one strategy is to maybe shrink the size of the pond. And if you can shrink the size of the pond, you can be a bigger fish and maybe be recognized to give yourself an opportunity to add value. But if they never see you or never hear you, it's really hard to add value.
Yep. That is, like, listeners, that's a great takeaway right there. Think about the fact that you don't need to be famous to 1 million people. You need to be famous to 200 people, maybe, or 150 people or 300 people or something like that. And you need to have influence in their world and be adding value to them at such a level that it's coming back around, just because that's how things work in this amazing universe of ours. So I think that's super smart. You picked a niche that you were already in, that you have very high level of expertise in your high tech sales position, and made that your pond. And another person that came to mind is my friend Scott Kidd, who he's a yacht captain in Florida, and he captains 300-foot luxury yachts out to the Bahamas and back, stuff like that. And he started a meetup group just for yacht captains. That these guys make a lot of money, they're busy as heck, they don't have time to really spend a whole lot of money, so they need to invest it. And he's providing a lot of value to them. Is that a problem that you're solving for your folks too? I mean, these guys are probably doing pretty well, right? They're probably bringing in pretty big commissions and have, like, the problem of, what do I do with this money, right?
Yeah, well paid. And what'll happen is the problem will be, what do I do with the money? And if they don't find something to do with it, then it gets spent.
Yeah. Yeah.
And they don't have time, right? I mean, it's a demanding role. So they don't have a lot of time to go out and get smart on buying, owning, and managing a smaller rental. They just don't want to deal with it, right? They're tired at the end of the day. And that's the last thing that they want to deal with is the toilets, tenants, and trash.
Mm-hmm, mm-hmm. Yeah. Yeah. So how long have you been doing High Tech Freedom? How long has that platform been around?
Yeah, so I've been working on it throughout 2020, and officially, I mean, the website's out, and I've been doing podcast recordings, but officially, it all launches January 1st. So, the timing of your episode is fantastic. We launch our first podcast on January 1st, and we'll start to transition to that brand.
And where would listeners go to find you and find out more about that?
Well, you can go to any of the podcasting sites and search for High Tech Freedom, High Tech Freedom Podcast. Our website is hightechfreedom.com.
Yep. Okay. Cool. So listeners, there you go. hightechfreedom.com. I'm writing that down myself. And then the High Tech Freedom Podcast debuting on January 1st. And what type of sales are people that are going to be listening to this typically? And like, what are they selling usually? Yeah,
that's a great question. So I'm bringing on other really highly successful tech salespeople, tech sales leaders, sometimes just other salespeople from other industries, some entrepreneurs, I try to bring in, like, I had somebody who came on and talked about really managing stress. So, somebody outside of the tech sales role, just so other people that can bring some value. But about 80% of the guests so far have been sales related, and most of those have been tech sales related. So talking through their career advice, experiences, lessons learned. You get somebody that's been doing it for 25 years, like, oh gosh, if I would have known now, back then, what could I have done? And so it's just fun to hear them take that advice. And so even if you're not in tech sales, even if you're not totally in a direct sales role, I'd still check it out, because no matter what your job is, you are always selling something. And it's a skill that every person, if they can get better at it, it'll enhance your career. Yeah.
Yeah. And I'm sure that most listeners don't even need this pointed out to them, but I'll just say it, like, you are in sales, no matter what you're doing. If you're listening to this podcast, you're in sales. I mean, you're going to end up selling yourself to lenders and investors and brokers. You're going to be in relationships with them. And the whole time that you're building these relationships, that's sales 101. and that's what it takes to get transactions done. And especially in this apartment space, it's a long game and it's a relationships game, is what I found. And especially as far as the broker side of things and the investor side of things, like you said, you're constantly selling. And so, if you're looking to sharpen your sales saw, so to speak, check out Chris's High Tech Freedom podcast. I'm looking forward to checking that out myself, Chris. So you were kind of reading my mind a few minutes ago when you said, like, if I knew now what I know, or if I knew then what I know now, right? Like, how would things be different? Looking back over, the course of, let's say, starting small. And I mean, you didn't start with single family, which is unique. You started with a duplex and you house hacked that. That was back before house hacking was a thing, or Bigger Pockets was a thing, or anything else.
Yeah.
But you did it. You figured it out and you did it. And that speaks volumes. But if you could, go back and coach yourself in those early years, what would you say?
I'd probably go start Bigger Pockets. Yeah, it's a good question. So I would surround myself with other people sooner. I look back at my early self, and I definitely had a more of a protective mindset, wanting to figure it out, do it myself, versus giving up something to get something. I just didn't really understand the value of having other people around you. You're going to accelerate what you can do, because you don't know what questions to be asking yourself. You can't sometimes generate a contradicting idea that then generates a different idea. And so surrounding myself around those types of people earlier, I just can't imagine where I would be now if I had done that. Mm-hmm. And I will say, I mean, one of my early lessons just in self-managing is just the power of record keeping. It's you just never know when you might need that information down the road. And, in the early days, we were doing it all paper, right? Ledgers, books, binders, lots of files. And, you think that stuff doesn't matter until you need it. And so it's easy when you only have a few units, but when you start to scale and then you have to go back and find stuff and go through your different filing structures, just if getting organized around that as you scale, I learned that the hard way when I had to go, find a document, found it, thank goodness. But it was a kick in the butt to get organized as we scaled. And then I would say, think bigger. My goal, I didn't share this earlier, but my goal had always been to build up 300 units that were totally paid off, because I figured that would generate more than enough income to do whatever we wanted, give back to whatever charitable cause we wanted to give back to. And now I look at it, it's not so much the units, it's, a cash flow that I wanted to get to. And I didn't really understand how to scale, but I didn't believe I could. And as I started to surround myself with other people, go to meetup groups, I started to realize, wait a minute, I've been doing it. There's no difference from a 20 unit building to a 100 unit to a 200 unit building. It was just my own head getting in the way. So I just say, be careful not to sell, be careful to sell yourself short, or not to sell yourself short. You can go big. Just find the right partners to surround yourself with.
Yeah. And you mentioned early on in the episode that back then you kind of had a scarcity mindset and you were struggling with that a little bit, or that was not struggling, but it was kind of coloring things, if you will. And what I hear you saying now is once you really embraced the idea of this being a kind of a team sport and having partners, and sometimes not necessarily having like actual legal partners or financial partners, but having like colleagues and people that you're bouncing ideas off of, and what I call digital mentors, like the podcast hosts that we listen to, and the audiobooks and the YouTube videos and all of those assets. When you surround yourself with people that think big, talk big, are confident about where they're headed, have maybe some track record to stand on, some credibility to stand on, you can't help but expand your own mindset, your own horizons, in my opinion. And
Mhm.
I would say when you started saying those three things, those three lessons that you just went through, like those are really almost exactly what I would say to myself if I could go back to 2012 or so when we got serious about our single family business. And I mean, first and foremost, I would say surround yourself with people that are doing bigger things and thinking bigger than you and are smarter than you, or if not necessarily smarter, definitely more experienced and wiser, street smarter than you, so to speak. I think that's tremendous advice, Chris. Let me just ask you this as well, just because I kind of geek out on deals. Tell me a little bit about what you guys are going after these days in the way of your deals, geographics, demographics, financial, economics, all that stuff.
Sure. Yeah. So I have two main partners that I'm working with. We have our separate logos, but we've partnered on every deal and, have some more deals that we're looking at. So we're focused in really 4 states, North Carolina, South Carolina, Atlanta, and Florida. There's other states that we're open to, but right now, those 4 states, we have really strong property management relations. So one of my partners, he lived in Atlanta and he's been doing this in that market for a while. And so some of the assets that he's had, we just have a really good track record with property management. And, so much of if you listen to any real estate podcast, there's so much out there about, the deal, but man, a lot of money is made on the operational side. So it's everything that happens after the closing that really can make or break the deal. So we're really passionate about the right property manager. And it's actually really hard right now, as you know, with a labor shortage. Property managers will take on your property, but then, do they have the staff to run it the right way? So, so looking in those 4 markets, our typical property, typical deal, we're looking 100 unit plus, that still in that Class C garden style. Usually, looking at a lighter CapEx project. The exteriors, kind of the standard units. Maybe there's some work that needs to be done on the pool. Typically we've had to go in and do some roofs, some gutters, some landscaping, some parking lots. If it starts to get too significant, we're finding boilers, chillers, aluminum wiring, Federal Pacific panels. We might say, let's just, see if we want to take that on or not.
Right. You said 4 of the scariest things in the apartment world right there.
Yeah. And ask me how I know, right? I've got them all.
Right. Boilers, chillers, aluminum wiring, and Federal Pacific panels.
Yeah. And,
yep.
And then, typically, when we're underwriting deals, it's interesting because, right now our typical deal has always been kind of an 8% cash on cash return and, trying to push it to the 1.8 to 2x multiplier on kind of a 5-year hold. I still see some deals out there that are 10% cash on cash and some pretty aggressive numbers. But when I'm poking around, I don't know if they're actually delivering on that. But we try to be as accurate as possible and conservative. And everybody says they're conservative, but we try to be pretty tight with our numbers. And typically have about a 7% preferred return on an 8% cash on cash target.
Gotcha.
Average annual return of 16 to 18%.
Yeah, that's a fantastic average annual return. So you guys are going cash flow heavy, not necessarily huge heavy lift on the CapEx, but you're going in and doing kind of some of the standard stuff and catching the communities up, so to speak, and getting them up to date and the preventative maintenance done. Are you typically modeling a 5-year hold or what?
Right.
Doing 5-year hold, and then are you guys planning on trading up at that point or refining and staying in, or what are your thoughts on?
Yeah, right now
exit?
It's I think with the market's exit, right, 3 to 5 years. I mean, underwrite it for 5 years, but I think there's probably realistically some that'll sell in 3.
Yeah,
and then go continue to look for the next deal.
That's what we're seeing too. Like, honestly, we do a 3 to 5 year hold, and on a lot of our deals anyway. And we even sometimes in our offering memorandums, we will project a range of returns based on the range of time of the hold period, so to speak, just to be full disclosure. Because, investors should know that they should. Yeah, my feeling is, and I know that, our PPMs and all of our legal docs say that the GP can sell basically whenever they deem it most strategically beneficial to everybody. But my feeling is that you should give your investors a pretty good feel for how long they're going to be in a deal, and stick to that as best you can, with clear communication if things change, and things do change, and you have to pivot sometimes, and sometimes markets shift, and et cetera. But what we found is, and you've been doing this actually a little longer than us, so I'm interested in hearing your thoughts on this. But what investors seem to really care most about is number one, knowing they're going to get their money back, and number two, just crystal clear communication is, and the more the better kind of thing.
Yeah, I totally agree with that. And it's something we were just talking about this morning on an asset management call. A property that we closed on. We'll be doing our first quarterly distribution in January.
Mm-hmm.
And I want to be real specific on the day, talking to the accountant, what day will those checks be going out? Because I want to communicate and then deliver on what we communicate and set expectations. Yeah. Because you can communicate all you want, but when it comes to the money piece of it, any ambiguity around that, I think is, rightfully so, should concern an investor. And so I always want to try to over communicate, but when it comes to the financial side of it, communicate accurately. You're not always going to be perfect. Sometimes things happen.
Right.
There could be delays. When actually one of my LP positions, they were delayed in their distributions this last round because of the holidays. So banks were closed 2 days, not a problem.
Yeah, it happens.
But I totally agree, and it's also I think it's good to communicate the challenges or the potential problems early. There's no reason to hide anything, right? If you're having a challenge, there's an unforeseen circumstance that has come up that's going to have to be dealt with. Your investors are going to know, and they're going to find out. Yeah. So the sooner you tell them, the better. But you better have a plan. I mean, it's no different than in my, my W-2 role, right? If you're going to lose a deal or you're having to struggle with a deal, well, fine. In business, right? Define the problem, but then propose a solution or propose a couple different alternative solutions and start working it. Mm-hmm. People want to know that you have a plan and, have a thoughtful plan that, that's been worked out.
Yeah.
That'll address the issue.
Yep. Good stuff. I just made a note to myself to be exact with our investors on disbursement dates. I think that's excellent etiquette, so to speak, and investor etiquette, if you will. Good stuff, Chris. Well, this has been fantastic. I feel like I've learned an awful lot from you. I've got a couple pages of notes here. I think your story has some really great takeaways. Just the power of partnership. The fact that you went from starting out kind of as a solopreneur and really dug in there, and then found that, kind of the enlightenment of having good partners and being surrounded by good partners. I'm very grateful for you taking the time to spend with us. I love your takeaways of how you would coach your younger self, and mainly just thinking bigger, right? Like, that's something I try to really instill in our listener base as much as possible is think bigger. And, I have a kind of a standing offer with our listener base that I will get on phone calls with them at their convenience. I've got a Calendly link where you can book a call with me. And I had a call with a group the other day, and they're super stoked about a 6 unit that they're doing in Illinois, which is like a 2-day drive away for them. And they're at the end of the day, they're assigning the deal and they're going to make maybe $15,000 assignment fee. And they're asking me about advice for the deal. And I'm kind of like, I couldn't help but say, like, think bigger, guys. Like, think a lot bigger than this. Like this needs to be like, if you do this deal, as you're talking about doing it, this needs to be a one-off kind of thing where you're just getting a little bit of capital injection and then you're going for something a whole lot bigger than this. And so, that was one of the biggest lessons I got when I started surrounding myself with bigger thinkers and heavier hitters is it's the power of the 5 people that you surround yourself with and spend the most time with. Right. I think that's Napoleon Hill or Jim Rohn or somebody that talked about that, but also your work-life balance, your work real estate balance, the way that you've managed to find a lot of fulfillment, meaning, and profit and everything else from your W-2, and managed to chase the dream of your real estate portfolio and have done that very masterfully. So I'm really excited for you, for you as far as where you're headed here in the near future, Chris, and in the distant future too. I know you had a really exciting goal of starting a nonprofit. You want to talk a little bit about that?
Oh yeah. I mean, just so I've had some experience working with youth as a scoutmaster over the years. And, one of the things that I've seen from my tenant base was that, there's a certain mindset that they have that they just don't think this is as good as, this is how it's going to be. They'll never get out of a lower end apartment. And I, early on, I tried to help them, just being a nice guy, and I realized I couldn't. But what I also noticed was over time, their children started to take on that same mindset. Because I've had tenants that have been with me for 10 years or more, and I've seen them sort of come up through, grow up over the years. And so the thing that I see that's missing in schools is this idea of teaching leadership, teaching life skills. Some schools have it, but your typical public school doesn't. And so I've been working on this idea of building a youth leadership and life skills program, kind of a coaching program. I'm looking at building maybe a for-profit version to fund a nonprofit version. Build up the quality that people are willing to pay for, that I can then take back into a nonprofit environment to other schools and other areas of need. So work in progress, but trying to leverage some of my past experience of working with the youth on this and take it to scale.
Yeah. And I love that you're willing to pursue, again, a dream or a vision that really is unrelated to either of your other paths in business, so to speak. I just think that speaks to just being kind of what I think of as like a Renaissance man, somebody that can kind of be a master in a few different things. And I'm a big believer in sticking to one lane and being masterful in one lane in the context of the real estate conversation. But like one of my biggest passions in my life is skiing, and I spend 60 days a year or so doing that. And, so like you go where your heart leads you and your soul leads you, and having a sense of purpose behind what you're doing, that's going to lead to the youth, the lives of youth being affected. That's really exciting.
Yeah. Well, thank you. And if any of your listeners out there have experience in that area and want to get together and just kind of brainstorm, I definitely cannot do this by myself. So, I'm open to working with anybody or talking to anybody that is passionate about that as well.
Cool. And again, best place to reach you, is it your website, hightechfreedom.com?
Yeah, that's a great spot to hit me up, or in LinkedIn. I am just Chris Freeman in LinkedIn. Okay. So it should be pretty easy to find. Okay, perfect. Listeners, there you go. Chris Freeman has been our special guest today. Thank you, Chris. I'm very grateful for you. Grateful to you for spending this time and kicking off the new year in an exciting way. Yeah. Well, hey, pleasure's all mine. Thank you, Tate. Yeah, you betcha. Listeners, thanks for listening to another episode of the Apartment Guys podcast, and we will catch you on the next one. Take care, everybody.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.